Welcome back to the Vital Strategies Podcast. I'm your host, Patrick Lonergan, and in today's episode, we have a fun conversation with Shauna the Tax Goddess. Shauna is a peer when it comes to building tax strategies for entrepreneur clients. We dig into everything from how to build a tax strategy based on the client's goals to managing cash flow for the entrepreneur. We also discuss things to stay away from when it comes to tax strategy that will get you in trouble. Stay to the end to hear how Shauna saved clients $112 million in one tax year. Let's dive in with Shauna, the Tax Goddess. All right, today on the show, we've got Shauna, the Tax Goddess. I am excited to dig into this conversation. Shauna is one of us. She is focused on the entrepreneur, making a very healthy income and driving down the tax bill. So I'm looking forward to just getting into the discussion as to how you do that. You've got an incredible team. I'm looking at, I think you've got about 105 people spread all over the United States and the world. I think you mentioned you're maybe in 17 different countries. And you've saved your clients over $1.57 billion with a B in taxes, which is a fantastic thing. And then we also look at the average tax rate that your clients are paying, and it's around 6.92%. So I think all of those things are fantastic. Every dollar we don't send to the IRS is left in the hands of the entrepreneur that is, out there growing their business. They're creating wealth for others. And so when we give it to the IRS, I feel like it's inefficient, gets caught up in the bureaucracy. And then, for every dollar that goes in, 5 cents trickles out to the wrong people on the backside. So I'm looking forward to this discussion today, just hear about how you do some of these things that we just outlined for the entrepreneur. So welcome to the show.
Thank you so much for having me. We're definitely talking about my favorite subject today, so I'm excited.
Yeah, fantastic. So I'm just curious a little bit about the process. So somebody comes to you for tax strategy, says, Shauna, help me. My business is growing. I'm making healthy income now. I'm writing 6, maybe 7-figure checks to the IRS, and it doesn't seem like my CPA can help with this. They're really good at getting the right numbers in the right boxes, but they're not helping me with any kind of strategy. So can you walk us a little bit through the process that you take a new client through?
Absolutely. So step one, of course, is get to know the client, right? Tax strategy is so customized to the person. We liken it to playing chess. Okay. Every single person, every single player has the same chess pieces. Okay. But you might be married. I might not be. Mm-hmm. You have kids. I don't. I have dogs. You don't. I own my house. You rent, right? Mm-hmm. Just the very basics can automatically start to change which tax strategies are going to work best, which are going to apply, which aren't, as well as on top of that, what are the goals of the person? Some people want to build the next empire, the Roman Empire, right, for their kids, right? And pass it on for 20 generations. Some people just want to slide into the grave with zero and their kids can figure it out, mm-hmm, right? They gave them a car to start and go build your life, right? So very dependent on who the client is as far as their aggression level. So we always look at it from a 0 to 10. 0 meaning the IRS never calls, never ever. 10 meaning we're all going to jail. Yep. Okay, and I know you've got a similar system, a level 4 fraud, which I love. Yep. So aggression level, what are the goals and what are the chess pieces on the board? Mm-hmm. And that will also look at the businesses, multiple businesses, single business, what type of businesses? Yeah. So are they in real estate? Do they want to get into real estate? Is it active versus passive? Do we have other, what we call alternative investments? So are mm-hmm. you in syndications? Are you in oil and gas? What kinds of things do you have? Yep. Because each one of these pieces will indicate whether we can or cannot apply any given strategy. So
yeah, I love it. I love it. No, because I think there's, one of the things that you've highlighted is there's 1,500 strategies you look at deploying for your clients. And so if I don't know your situation and your goals, it's really hard for me to figure out what strategies I need to start looking at, because they're effectively, when you start combining them, there's an unlimited number of things we could do for you. So we have to narrow that down by understanding exactly what you said. Where are you at currently? Where do you want to go? Let us marry the best strategy with where you want to end up. So I love that. Thank you.
100%. And I think this is one of the biggest places where we see people getting themselves into trouble, right? Is either they get, oh, well, my neighbor next door did this and that saved him a ton of money.
Yeah.
Or especially now with TikTok, YouTube, oh, I saw this strategy on a 30-second TikTok and I'm going to go pay my kids. Hold your horses. Yep. Not saying it's bad, not saying it's good, but you better do it right if it applies to you and if you should do it in the first place. Yeah. So, a lot of GPT, the whole AI revolution here is I'm going to get tax strategy from the machine. Yep. You can. Just be prepared for the consequences, right? So,
And it's hard to enter all of the relevant data into the machine so they know, exactly what you have going on and to try to give you advice. And it's interesting. You can ask the machine one question and then ask it sort of the opposite question and it'll agree with you both times. And you're like, wait a minute.
Every time.
What are we doing here? So, I love that. And just pointing out things like, the multiple businesses. And if you have kids, like it makes so much more sense to pay the kids through like a pass-through entity versus an S Corp, because then they don't have to pay the payroll tax. And it's like, those little efficiencies, getting plugged into someone like you is, can make a big difference on the number of dollars we're sending to the IRS. So
100%. Love it. And I'm with you. Keeping the dollars in the pockets of the business owners, because at least from our perspective, the business owners are the background of this country, the backbone, right? They're the ones that make jobs. They're the ones that make decisions. They're the ones that push money in and out through the economy. Yeah. So if only 5 cents are trickling through, I don't like my 5 cents. Yeah. So
absolutely. That's wonderful. Okay. So you onboard somebody, they come in, you figure out where they're at and where they're wanting to go. What happens next? How do you start to devise a plan and look at different scenarios?
So this is always the part that everyone hates. Okay. In order to do our job properly, my team and I need data, lots of data, lots and lots and lots and lots of data. And I always phrase it down to the fact that, listen, I need to know what breed, what height at the shoulder, and how big your dog is. Right. Like lots of data down to that nitty gritty detail. Because it is those details, and if we stick on the dog example, it is those details that tell us whether or not we can get a tax deduction for wherever it is you're spending your money, right? And how we tweak it and where we move it. And so, gathering details, typically we come back with what we call to-dos. So very first round of to-dos. Here are the 10 things. Call this guy, set up this account, move this money, get the kids on payroll, whatever the strategy is. So those are the to-dos. And then over time, typically 3, 6, kind of depends on how big and complicated you are as a client. Longest time period we've ever seen is 16 months, but we saved that client $112.6 million in one transaction. So the planning can be fast, it can be long, really depends on what it is that you're doing and what's happening. The point of it is to have an ongoing relationship that, side note, is not only with us as a tax strategist. We want to be involved with your financial advisor, your attorney, your estate and trust attorney. We want to be involved with, if you have a financial advisor separate from a life insurance advisor. If you're in real estate, we want to know the broker, right? So we really end up as a part of your financial team, along with, and on top of often, the CPA and the bookkeeper. Because the bookkeeper's job is to record everything. CPA's job is to take the numbers, drop them in the return, make sure you're not going to jail, right? Check all the right boxes on the actual filing. The strategist sits in between all of those people to say, okay, great. If we do this and we pull in the attorney's information and we pull in the life insurance planning information, what is that going to do? Big picture over the year, 3-year, 5-year, 10-year, 20-year, 30-year, empire building generational level years, time spans for you and your family. So it's not a one and done kind of thing. Generally, it's a little more involved.
Yeah. So. And what it sounds like you're describing is almost like a multifamily office structure where you're sort of putting yourself in the middle and coordinating a lot of these different pieces to make sure that, because oftentimes what we see is clients are siloed, right? Like their tax person's doing one thing, their legal person's doing something else. And that was great for asset protection, but it's not helping us.
They're stepping on toes.
Right, on the tax side of things.
Problems.
So, that's wonderful. So
and these days, as a successful business owner, you really have to do that. Because if you're siloed, you will step on each other's toes. Right. I've had multiple cases, and I'm sure you've seen this too, where someone comes in and says, the attorney set up this beautiful structure for me. That always makes me nervous right off the bat, because then I get the diagram and it's 25 entities and multiple trusts. And you look at somebody and they're making $1 million take home. Yeah. 25 entities for $1 million. You are paying more in legal fees than you would have if you just stick with one entity and you were still legally protected. Yeah. So it breaks my heart sometimes when I see that kind of thing. And that's why you've got to have that team.
Yeah. Yeah. So, no, I love that. And we talk a lot about our levels of tax planning, but we have what we call 4 cornerstones of wealth building. It starts with cash flow. If we don't know your cash flow, we can't really do the tax planning. Then once we get the tax figured out, we move on to investing, and there's different levels there. And then the final one is protection, right? And that includes both the legal structures and the insurance. And sometimes people get awfully tied up about their like legal structures. And I'm like, wait a minute, you haven't built any wealth yet. Like go like
make some money,
right?
honey.
The person you were just talking about, it's like, maybe when your net worth's at $100 million or $50 million, sure,
let's talk about
that structure
Yes.
makes a lot of sense. Not when you've got $1 million and you're paying a few $100,000 to your attorney to set all this stuff up. So wonderful. I so appreciate that. All right, so I guess I'm curious about like, what is you said the longest it took was 16 months and you saved that client $112 million in tax. That's fantastic. I'd almost like to just take and make that a case study, but we'll put a pin in that for a second.
Okay.
What does your meeting rhythm look like? Like, how often are you connecting with clients to sort of implement all of these strategies? Is that like we meet twice and we can do this? Or is it like, no, clients got to show up on a regular schedule so we can move the needle?
I love this question, and you're going to hate my answer, because the answer is it depends. Okay. Now, we have had some clients that come in. Let's take a more average client, right? 6 to 9 months. Okay. Like for the whole thing, we're done. They're not huge. They're not tiny. They're more average. Okay. Typically right off the bat. So there's a meeting first. You sign up, there's a meeting. Okay. Another couple of weeks, there's a meeting. Another couple of weeks, there's a meeting. For most people, what happens is after 3 or 4 meetings of, I don't want to call they're super intense, but they're pretty intense, right? For most people, they don't know tax knowledge, which is why they're coming to a specialist in the first place. So for taxpayers, it can be kind of intense, right? There's a lot of information, a lot of stuff going on. After 3 or 4 meetings, most people generally have an idea of what they're supposed to do. And so the meetings will start to stretch out to like a month, maybe every other month, right? Until everything is done and we get it handled and we're just checking stuff off a list, right? Get this done, get this done, get this done, call this guy, do the thing, right? Now we've had some clients that come in and say, listen, I had one just 2 days ago, say, you know what? I'm actually taking the month off, completely off, because I want this done. And I'm like, oh, okay. So within our firm, every single client gets assigned, they have a customer care rep, they have an admin rep, they have a tax strategist. They of course have like final level reviews, this kind of thing. So however fast the client wants to move, we will move. So we have had some cases, we have some that are 3 years ongoing and still aren't done, right? Because business gets busy and I'm working on it. And, listen, we will move as fast as you want to move. But the one thing that I really like the way you just phrased that is the client must participate, right? I can tell you what to do, how to do it, when to do it, but I am not you, right? We cannot open a bank account for you. We can't sign for the trust documents. There are things that the client has to do. And we've seen cases, and I'll be very honest, we've seen cases where the client has tried to offload that to an assistant. The assistant is also not you. We tell people right up front, if you are not willing personally, to put in at least 40 hours on this, don't sign up with us. Just don't.
I love it.
It won't work. So,
and it's interesting because we talk about internally like planning tolerance. Like how much tolerance does the client have for planning? And if the tolerance is really low, like we might be able to be super efficient. And I'm going to give you an extreme example. Like, we can do all these strategies. And by the way, we want you to move to Puerto Rico. Okay. Like that takes a tremendous amount of planning tolerance to pick up your whole life and move it to Puerto Rico. Right. But you're going to save a ton of money in income tax. they might be like, no, I'm not doing that. Or it could even be, we're going to move you from New Jersey to Florida or New Jersey to Texas or whatever,
Not happening.
they're just like, no,
And your phrase is so much more professional than ours. We call it the pain in the ass fee, yes. Right? There's every strategy has a PITA fee, and some of them are very easy. You pay $500 to a guy, and that saves you $10,000. Right. Some of them you pay $100,000 to move and your family and buy $1 million condo in Puerto Rico or whatever, but it'll save you X amount over 4% for the rest of your life. So, love it.
Yeah,
love it.
Yeah, no, that's good. I so appreciate that because we just find like sometimes we sort of bump into the planning tolerance of clients and it's like, okay, hey, look, it's all right. We can save you more money.
But tell us.
But we just need to be clear. Like, do you want us to push this forward and we need you to be engaged in the process or not? Because it's going to take more than just, go ahead and do that thing. We're going to have to, could be setting up entities and we need you to understand and get us data and all those other pieces. So that is fantastic.
I think that's the common concern across most professionals, right? We as professionals, any of us, lawyers, CPAs, financial advice, doesn't matter. We can tell you what to do, how to do it, when to do it, but if you don't actually do it, nothing we can do.
100%.
Right? So
no, I love that. And that's the challenge with the entrepreneur. Like their mind is set on like, I'm going to grow my business and my goal is to get them to shift for a second and go, look, your biggest expense right now is income tax. Like, let's spend a little time hacking that expense down. And then once we're...
so that you have more money.
Right, that you have more money to take and grow the business.
There are always stories. My favorite story that's ever happened. So I've been in practice now for 25 years. Tax Goddess itself just turned 20 years old this August. So last month, basically. My favorite story, like year 3 of my business, had a Schedule C come in. They were taking home about $3 million on a Schedule C. Okay, so self-employed, no S corp, no separate entity, Schedule C.
Yeah. Okay. And can I just make a quick comment for those that don't know what Schedule C is? So
sorry.
No, it's great. So we think the C in Schedule C stands for catastrophe. If you're making a big, income on the payroll tax side of things, it's just a payroll tax catastrophe. So there's more efficient ways to do it. But sorry, go ahead. Yes.
All good. And so, you're leading me to my point. So I said to them, listen, at a minimum, please, let's change you to an S corp. Let's get up an entity set up. Let's change it minimum, like one strategy, one piece of paper. I just need you to sign one piece of paper. You file one tax return. I'll take care of the tax return. We're good. And their response literally was, no, we don't want to. We just want to pay our bill. And we don't want to cause any problems. I'm like, okay. You can't force somebody to do something they don't want. And so what we've realized is that to a client, to anyone, there's a certain level, and this is why we call it the pain in the ass, right? There's a certain level of fee, and that fee is the taxes. There's a certain level that you are willing, each person is willing to put up with before they say, you know what, enough is enough. And the clients that do really, really well with tax planning are the ones that have said, enough is enough, and I'm going to fix it because they are driven to do what they need to do.
I love it. So you also have a focus that I personally love, and it's around wealth building. So what your tax strategy doesn't involve is telling me to go buy a Mercedes G-Class for, $250,000 so I can, write off that.
If you want it.
If I'm going to buy it anyway.
If that was your dream, it's great. Let's plan.
If I'm going to buy it anyway.
Do not go buy a car just to get a tax write-off, please.
Or more equipment or, whatever. Unless we need this to grow the business, please don't spend $1 to save 37% federal tax. Like, it doesn't make any sense. So can you just touch a little bit on because I think that's a mystery to some people. Like, that's all I know for tax planning. Like, all I know is I just spend money on stuff. I don't know how to build wealth with my tax strategy.
100%. Well, and I think just to note that really quickly, I think the reason why that's what people know is because that's what they've been exposed to. Okay. So one of the pieces that many people just don't even realize, according to Google, there are 660,000 CPAs. Okay. CPAs do all sorts of things, right? They prepare taxes, but they're also controllers, auditors. They do all these things. There are only 60,000 that have masters in taxation. So those are the people that start to specialize in taxation specifically. Then you start looking at the planners, certified tax coaches, people that are certified for tax strategy. There's only 607. Certified tax professionals, there's only about 200. Certified tax strategists, people like me, there's only 15.
Wow.
15. So when I hear taxpayers come to me, to our firm and say, yeah, I was told to buy a car, I was told to buy another rental property. These are the strategies that a normal general CPA, and we love them, and I'm a CPA too, okay? But that a normal general CPA who doesn't specialize in tax, these are the strategies they know, because it's the strategies they've been taught from their mentors and their mentors, right? And maybe they saw that one TikTok video. I love TikTok.
Yeah.
There you go. I love watching it just to see what people are saying, which is a whole nother issue. But when you start to talk about, and we call it empire building, right? Wealth building, whether you want to pass it on or you want to give it to charity or whatever it is you decide you want to do with your money, to actually build wealth, you've got to keep it. So, okay, instead of buying the G-Wagon and it immediately depreciates the instant you drop it off the lot, right? How can we build that wealth? Now, some of my favorites, you and I were kind of chit-chatting earlier, captive insurance, okay? At least you're paying yourself the money. I like it when you pay yourself the money. I also like it when you can double dip on the money. So things like infinite banking or premium financing, where you're paying yourself, it's having earnings, and then you can borrow your own money to then go buy another asset, which will also grow earnings, like putting it into a life insurance policy, borrowing it out, buying a rental property, then outgrows equity.
Right.
I love double dipping. I've seen triple dipping. Making sure that the money stays within the family. So creating private foundations or using family limited partnerships to pass assets without taxation, not only live while you're alive, but also, of course, for estate and trust purposes. So when we talk about building wealth, for me, the focus is always trying to keep the dollars with you first and then going to any alternatives. So if we have a $2 million net taxable income that we're trying to drop, if we can use a CLAT plus a private foundation plus what else do we want to do? The 831B, if we can use these things, captive insurance, 831B is captive. If we can use these things to move all the money to you first and we get your net taxable down to 300,000. Now let's go look at oil and gas. Now let's go look at solar. Now let's go look at places where sure it's still an investment, but the money went to somebody else. The cars really, unless you want the car, it is the last thing on your plate. Like way down the chain, way down. So
thank you. I live in the Midwest. We have a number of farmers, and it's like every year they're buying more tractors that they don't need, building another building, and I'm like,
who needs a fleet of tractors?
This isn't going to work. So long term, they like that they pay almost no tax, but I'm like, you're paying a tax of those tractors sitting on your property. Unless you're creating a leasing tractor business, which I'm all about, then I'm in. So great. So I want to, one thing that we also pay attention to is, we talked about our levels of tax planning. Level 1, IRS gives us guidance, doesn't take any investment. Level 2, IRS gives us guidance, but we're have to invest dollars. And these are plans outlined in the code, like cash balance plan, 401k, IRAs, that type of thing. Those are low cost or no cost to set up. Then we start moving to level 3 strategies where we're combining sections of the code. And you just gave us some pretty cool ideas there. But generally what we see, and we need to be careful, this goes back to one of the things you brought up too, is like, sometimes clients will come to us and we work through them in that order, right? Like we don't start with some super complex structure because those cost money to set up, right? So we need to weigh the cost of setup versus the income tax, right? And sometimes there's like a flat fee to set this thing up. So if we're putting in $100,000 and it costs $30,000 to set up, okay, that
what's
makes
your tax
sense,
bracket?
right?
It depends,
right? There's
depends.
30% tax on that strategy in the form of administration. Where if I'm putting $1 million in and I've got a $30,000 setup, now my tax is down to 3%. This makes a lot of sense. So, do you see that as part of the equation. You have people coming to you going, hey, I've got this cool idea, or you look at it and go, hey, here's a cool idea. But by the time we set all this up, we actually haven't saved a whole lot of money.
Saved anything? Yeah. So, the goods and bads, right? Because of the nature of what we do, we get approached by all sorts of people all the time. Literally 3 or 4 times a week, we'll get a call. Hey, we've got this cool thing. We've got this program. We've got this. Step one here, and I think this is a good baseline to lay. Because I am a CPA, okay? I'm not just a tax strategist. And I like to bring this up to people, okay? Because sometimes we'll see, I'm a tax strategist. They don't really look at, has there been a private letter ruling? There's a legal opinion, but any attorney can be paid to write a legal opinion. It doesn't necessarily mean that the strategy is even good, is even above board, right? Then you start to look at costs. Then you start to look at, well, how is everybody getting paid in this deal? Because we've heard cases of people saying, oh, no, there's no fee for this. I'm like, there's a fee somewhere. Somebody's getting paid for something. Nobody does nothing for free, right? So one of the things that people really like about working with a CPA who is also a tax strategist, it is my job, it's my duty as a CPA to be a fiduciary for my client. I don't get paid. I don't get commissions. I don't get referrals. I don't get kickback. None of that. If the deal itself is not a good deal, then we don't recommend it. Period. So, yes, you have to look at every single strategy. You have to look at it from a risk level. You have to look at it from a return on investment level. You have to look at it from the IRS's perspective, right? Is this on the dirty dozen list? And if it is, is this the good version or the bad version of what's on the dirty dozen list? Got to look at it from that level. And I think that's where a lot of taxpayers can kind of get themselves into trouble, because my neighbor did it and he was fine.
It just means he hasn't gotten caught yet, right?
Exactly. I mean, we look at, take for example, the basics, right? We were talking about captives here. There are captive companies out there that at this point have a 90% audit rate. We won't touch them with a 10-foot pole. Why would I send my client to somebody who's effectively automatically going to get audited? We have other captives that are at a 3% audit rate and 100% win rate. So, if you're not working with somebody from a strategy perspective who has multiple referrals, who has done the vetting process, my suggestion would be run away.
I couldn't agree more. And we had a client come to us that had a captive. We saw how it was being run and administered. It was so sloppy. I'm like, what is happening here? And then lo and behold, he ends up in prison. And it's like, okay, the administrator, that's running this.
Oh, I was going to say, I'm like your client.
No,
oh my God.
The administrator. And it's like, okay, it's not a surprise to us. Like, let's shut down this captive, start up a new one with somebody that actually knows what they're doing, that's going to run this thing, has a good track record, can do it efficiently. 100%. So, that's fantastic. And even, just looking at, you're right. I had a client that was looking at selling their business, and they got a legal opinion from an attorney. And I looked at the legal opinion, and it's like, the attorney's not, all this is on their letterhead. They're not saying this strategy.
It's letterhead, copying and pasting, whatever from the IRS code.
It's like there's, he's saying this is where this can fall apart. And like, if you're sending this to me as like confirmation that your attorney says it's okay, like, you should run away from this strategy, that this person put in front of you. So it's
but to your point, okay, a taxpayer, a normal business owner does not know that. And I think this is why I laugh about TikTok so much, right? Because unless you're working with somebody who knows, who's qualified, who has an audit rate history, who has done the thing, approved the thing, been doing it for so long, right? If you start working with somebody and they've got a year experience, they don't know. They haven't seen all of these pieces. And, sorry for all my tax strategists out there listening who've done it for a year. You just don't have the experience. You just don't, right? And I think that's, I'm ex-KPMG. I don't know about you on your end, but so, before I started my own firm, I was KPMG. Like, this is, experience matters in these kinds of things. And being able to sniff out what is BS versus what is true
Yep.
is hugely important.
Yeah. And we just have sort of a general test internally, right? Like, is there business purpose? Can we substantiate it, right? Like if we look at this and it goes straight to, this is purely a tax move. That's the only thing we're doing is not paying tax doing this. The IRS is going to come and look at it and go, we don't like this. And it's going to cause a problem at some point down the road, right? So if we don't have some sort of alignment in like, hey, this is accomplishing our goals and there's some, we just look at the code is like one of two things, right? It's either incentivizing behavior. We look at accelerated depreciation, right? The IRS encourages us to go develop things because the government's not good at it. Or like we look at tax on tobacco and it's like, hey, don't do this thing because it's bad for society. So it's like, if it doesn't have some sort of string attached to it, like I'm going to put it in this thing and use it like my personal checkbook, I think we're going to have a problem. So I love all of that. So I think one thing too that is super important that we haven't talked about yet is, let's say I make $1 million, okay, and I spend a third of it on my lifestyle. And before I call Shauna, I spend a third to the IRS, and then I save a third, okay? Sort of falls into those buckets.
Okay.
When I reduce my tax bill, let's just cut it in half, okay? So now I've got
instead of paying $300,000, we're doing $150,000.
Right. So now I've got $150,000 of money I'm not sending to the IRS. So what I've done is I've just increased my cash flow by $150,000, which is pretty cool. And I don't think most people realize like, I was saving. Let's pretend they don't change lifestyle, or they take one nice cool trip on, 50,000 of that, and they take another $100,000 and they invest it in something. So it's like we just increased our wealth building by
time value of money. Oh my God.
It went up a third. So it's like now we're compounding, we're accelerating our we talk a lot about financial freedom with our clients. Not that they're necessarily going to hang it up, but when they have the freedom to not have to worry about like, continuing to build the machine, like it gives them freedom to like run things the way they want to and pursue those passion projects and all those other fun things. So I think, I don't know if you have anything to chime in on with like the free cash flow and what that can do for people, but I think that's sure, I'm not sending it to the IRS, but now I get to use it. So that's, we think, an amazing thing.
Well, you hit the nail on one of the big things that we see happen, which of course is lifestyle, right? And so again, for me, this goes back to the goals. What does the person want? Okay. If you have no children, you're not into charity, you don't care about building an empire because who are you going to leave it to, right? Then it's your money. Do what you want with it. Okay. Right. If you want to spend it, you want to go buy a yacht, do that. Do whatever makes you happy. Okay. So it does come down to goals for me. Okay. Watching the lifestyle spending for sure. And I think the other big thing that people, they don't think about because it's not currently omnipresent, right? At the moment, I know what I'm paying in taxes. I know what I'm paying for my lifestyle. Okay. You don't know what none of us know. What is our health going to be like when we're 80? What is the economy going to be like when I'm 80? Is 5 million enough, or does it need to be 10 million? What's going to happen to inflation, right? And so the older generations, the boomers and older, were very, very, very good at saving. They were trained, you save. And that's because their older generations, which was the Great Depression, told them, you save money because you never know. You have no clue, right? And so the younger generations, which is what we're seeing now as far as our business owners, they're really starting to make money. They're really starting to do these things. They grew up in an arena where, you should save money, but you can spend it too. And looking at taxable versus non-taxable income in retirement is a big piece. So again, I love life insurance from that standpoint, all different kinds, whole life, IUL, whatever. I don't sell life insurance, but I love it as a tool. So I love looking at life insurance for tax-free income. If we can do some conversions into Roths and QPRTs, whatever it is that we're doing as far as conversions into Roth, I'm all about it. But getting a little more balance in life tends to be good. So watching the lifestyle creep, watching where that money is going, what are your goals, and making sure that you have taxable and non-taxable for when you get there. Because side note, our government could also just change their minds. They could change the Roth and it's all now taxable and you have zero control. So diversification is big for me.
Yeah, I love that. And it's been interesting to watch. Like we've had clients making, I feel like there's a little bit of a threshold, and this can change depending on where you live in the country, but we feel like clients get to about that $1 million a year net income. They spend about 30 grand a month. And then we've seen clients go to 2 million and 3 million. And that 30 grand is sort of we could call it 35 or 40, but it stays about there.
Yeah.
And we've had clients make, $1 million a month, and they're still like in that threshold. Because one of the cool things is like so much of their lifestyle was soaked up in their business, like all of the travel was business travel and, that type of thing. Yeah. So I say that, but then we have, and so I think the entrepreneur has been through the ups and downs, and they sort of figure out like, actually more stuff isn't going to make me any happier. I can go on a really nice vacation and still, it'll be okay. And I don't need a bigger, faster, shinier fill in the blank. Now we see some of the billionaires with a 300-foot yacht go buy the 350-foot yacht because their friend bought the 320, but that's probably like,
grass is always greener, right? The Joneses next door every time.
There's probably some unresolved trauma from their childhood that just isn't dealt with there. So I know, feel for the billionaires, but I say all that, but then we've had doctors and sort of professionals that have made a couple $1 million a year, and they're spending 2.1. And it's like, what the heck is happening here? And I think there's something to like, that lifestyle creep seems to come into play when people haven't been through some of the ups and downs. And it's just like, oh, I can just go buy a bigger, house or another house. And then the vacations can, we'll just take the whole family private. And it's like, oh my gosh, quit it. So
one of the things that we implement with all of our clients, and absolutely in love with it, use it myself, is profit first accounting.
Yep.
Okay. And this really tends to curb that concern, right? There's actually a great app, Cash Goblin, for anybody that is looking at profit first accounting. It's automated, all these kinds of things. The profit first accounting basically says, listen, for every dollar you bring in, doesn't matter whether it's $1 or $1 million or $10 million, for every dollar you bring in, you decide ahead of time how you want to spend that money. So 5% on all the fun stuff, 30% on taxes, 10% on retirement. Like whatever those numbers are, you pick them, you choose them. There are, if you go read the book, it's by a guy named Mike Michalowicz. He does give you some very specific guidelines. And we like those. Sometimes they're a little too strict for people. So I love teaching anyone that we work with about profit first. It's built into almost everything we do, because then you don't run into what you're just talking about. Because the instant you start hitting debt, and listen, I'm good with good debt. Okay. I'm all good about leveraging to buy insurance, leveraging to buy real estate. Like those kinds of things are fine. But getting into debt to go buy a yacht. Unless we got a business purpose, I'm always torn.
And even if you've got a business purpose,
profit first methodology,
it's probably not cash flowing, so for the yacht.
I've seen a few.
Okay.
I've seen a few.
Right, good,
I've seen a few. But yeah, you're right. I mean, listen, guys, if you're going to buy an asset, well, we go back to Kiyosaki, right? Robert Kiyosaki. An asset is something that makes you money.
Puts money in your pocket, right?
Right. A liability is something that costs you money. It's your choice. Right. Whatever you want to buy, there you go. So,
and people get super spun up about, because Kiyosaki says your personal residence is a liability. It takes money out of your pocket. And people are like, no, 100%. It goes up in value. And it's like, well, maybe when you sell it, but
not as fast as you're spending it.
And I think you're absolutely right on the profit first side of things. From our perspective, it's, I'm going to rewind like 20 years. I listened to a guy by the name of T. Harv Eker outline this, this financial strategy where you just had percentages. Like every dollar that came in went into these different buckets. And I'm like, this is brilliant. And I think what the key is you have to have a plan. You have to have a framework that you can operate your money inside of. If you don't, it just gets spent. Like it just all goes into one account and it disappears. So if you automate your...
Which is why, side note, I was just about to say, that's why we love Cash Goblin. Because you pick it, you choose it, you don't even look at it. Out of sight, out of mind, which means the only account you look at is your main checking account. And either you have the money to spend or you don't. And it really just manages the psychology for people, because money psychology is one of the things that just is not taught. And it's one of the hardest things for people to get over. So
I love it. Wonderful. So we can head down this tangent or not. Like one of the things is like we look at the different types of tax that come in, right? So, and what I mean by that is like we've got some clients that are growing very healthy businesses, and they're might sell that business, or they might sell an asset, and they're like, oh, the capital gains tax is coming, and there's not a single tax that I like, right? Like not one. If I could not pay any of them legally, I would find a way to do it. But
Good question.
If I have to prioritize my taxes, capital gains tax isn't the first one I'm going to eliminate because it's pretty cheap in regards to,
comparatively.
To the income tax. So it's like, I'll attack the income tax first, because if I get $1 of deduction on the income tax side, it's almost worth $2 of capital gains tax savings, in regards to deducting.
In California, it's 63% on ordinary. It's
amazing.
Yeah.
I don't know. And we've had clients sort of leaving California, just moving to Texas.
Amazing. I wonder why.
I know. It's weird. Like they followed Elon. They're like, we're out of here. We're going to move to Texas. And, Austin seems to be the hotbed for, all the California natives. But so I don't know if you have any thoughts on that, because one of the challenges we actually have on the capital gain side is like, okay, let's really go attack this. I don't feel like there's quite as many tools on the capital gain side as there is the ordinary income tax side. And there's things that I maybe could be missing, but it's like we've got a few trust options, we've got qualified opportunity zones, we've got a few of those.
Hopefully we'll have them for another year, maybe here. I think, so let me back up. To me, ordinary capital and then retirement, like investment type taxes, right? These things all happen in a timeline, right? Because normally to get a capital gain, you have to have had something, held something, and then you're selling that thing. Now that could have been a business, could have been stock, it could have been whatever. So if we're talking about the example of a business, right? Well, I started a business with nothing. I'm starting in the ordinary gain phase, right? The ordinary taxation phase. So of course, during that phase, I want to reduce that phase as much as possible. So all of the ordinary strategies are great. When I get to the point of selling, now there's about, we look at about 30 strategies on the capital side. And again, it's almost as if the conversation starts again, right? 5 years out from selling your business. Right. Okay. Well, what do you want to do? Do you want to pass it to the kids? Do you want to give it to the employees? Do you have any employees that you trust to do that? Do you want to just sell it out to private equity and be done with it and get your cash? Do you want one big payment all at once? Like, do you want the lump sum, or do you want an annuity stream over time? So it's almost as if we start the process of redoing tax strategy again, because now we're looking at a different, almost like an entirely separate thing. Once the capital gain has occurred, right, generally in a business sale or in a massive stock sale, something like that, most planning, not all planning, most of it, 98% of it must be done before the transaction. And I think what ends up happening with a lot of people is, we see it, I'm sure you see it. They come in and they're like, I sold a big thing. Now what? And I'm like, well, now you've shot yourself in the foot. Right. Because, now there's like 3 things we can do, and pick your poison, right? But if you can plan ahead of time for any capital transaction, you can absolutely get that capital transaction either to zero, like period, zero tax, doesn't matter how big it is, or at a minimum deferred over a couple 100 years. So there's lots of options to get out of the tax, but still give you the deferral, give you access to the capital, be able to meet whatever other goals, your charity, pass to the kids, like whatever those things are. And so, yes, are there things you can do? Yes. Should you be planning in advance? Absolutely, right? If you come to us, and I was kind of half mentioning, right, the opportunity zones, I'll believe it when I see it, if they extend or don't extend or what's happening. But those guys are set to sunset really soon here. So, some of these options that are post capital gain sale, like an opportunity zone is post sale, some of these options are also disappearing. Okay. As you mentioned earlier, the government likes to kind of guide people where they're going, right? And they like you to plan things. They like to know what's going on. So, anyway, so
I love that.
Sometimes you'll get it at the same time, but
good. That's fantastic. And one thing that you highlighted that you mentioned selling it to the employees, because Personally, I love the ESOP because there's two tax-free entities in the United States. We've got the ESOP and we've got the credit union. And most people aren't going to go fire up a credit union. So the ESOP is what we think is a fantastic strategy to employ if you're going to sell the business. And there's just lots of opportunity there. So and then just think of the strategic advantage it creates for the new owners. Like, hey, you don't have to pay any tax on this entity level. It's good. So wonderful. Yeah. Thank you. All right. So Shauna, this has been fantastic. I know we, carved out about an hour. So I don't know if you have any, I'm still curious about that $112 million tax savings. I don't know if you can give us a quick summary of some of the opportunity that appeared there and what you executed on, but that always sounds interesting. Sure. Anytime we don't send 9 figures to the IRS. So
I will take 9 figures. Yeah. So did the owners. I was very happy. Actually, it happened to be a business sale. It was a part of a negotiation. We had 5 partners, all selling. If I remember right, I think the total sales price was, $986 million or something like that. Big numbers, right? This was a huge buyout. And so part of the reason why it took so long is because one, big numbers, right? Big companies buying, buyers, sellers, all the things. Second one, you had 5 partners. So when you plan for a multi-owner entity, you're not just planning, when it's you and you own your business and it's you and your wife and the two of you can sit across from the dinner table and you can have a discussion and determine what you want to do, you're fine. When you start trying to negotiate with 5 business partners, one guy didn't want to do it. One guy thought it was a scam. The other 3 were good and they were in. And so everybody was negotiating all the things. So it turns into, what generally is a very easy strategy from that standpoint. In this case, it was setting up 5 distinct trusts, would have been 5 trusts for the 5 owners. It just turned into drama for a year, basically. So I was thrilled because they actually came in at what I would call the very last minute. It was 24 hours before the paperwork was supposed to be signed. And the 5th guy said, fine, you've convinced me, we're in, right? So, really when you're looking at tax strategy across multiple owners, even if it's you and your partner, not married partner, but, we have clients, buddies, when they were 19, started a business and they've grown this business to 50 million and now they're ready to sell. If you can't get doesn't have to be, but often, if you can't get both parties on the same page, it will cause negative tax consequences to the other party. So really, again, I go back to 5 years before you plan to sell anything. Talk about it, open it, look at the books, get everybody on the same page. At a minimum, we see problems when people haven't done that at least a year out. So if you can start at 5 years, great. If it's already in your operating agreement for those, this is how we work with your attorney to make sure before you start the business, this kind of stuff is in the operating agreement. So it really, when you look at, I think it's the part that I find the most fascinating about what we do. Many people look at taxes, it's a 1-year thing. Whatever happened this year is what I'm going to pay. It isn't. It is a lifetime planning, looking at what are the potentials, what are the options, where do you want to go, and bringing in the experience, the knowledge, what has been seen before, what can and cannot be modified, literally until the very last moment that you sign that paper on that business sale or whatever it is. So,
wonderful. That is fantastic. So, Shauna, the tax goddess, this has been a great discussion. I love anytime we don't have to send money to the IRS. Let's say somebody's listening to this and goes, hey, I love everything Shauna's saying and I need to get plugged in. What is the best way for people to do that?
We are super easy to find, taxgoddess.com. And if you're looking, you had mentioned earlier somewhere the 6%. The book that I published last year, this is my 2nd book, 6% Life. You can buy that on Amazon. It's got 7 of the top strategies that we use, along with pitfalls, things to watch out for, that kind of deal. It actually beat out Think and Grow Rich for about 3 weeks on the bestseller list. So,
good for you.
Who wants to pay taxes? Go have at it, guys, right? So, taxgoddess.com, super easy. If you reach out, you'll talk to the team. I get involved a little bit further down the road, but all the good things.
Wonderful. And we'll make sure there's links to all of that in the show notes. And Shauna, this has been great. I feel like we could have you back quarterly and just dive into a particular tax topic.
I would love to. Let's go pick on some of the strategies. Yeah.
Wonderful. All right. Well, thank you so much for joining us. I appreciate all of your time and energy and the good work you're doing saving entrepreneurs billions of dollars
Let's
in income tax. So thank you.
Well, thank you so much for having me. Such a pleasure.
Thank you for listening to the Vital Strategies podcast. We're giving away our new planning tools that we've developed. We'll be charging $99 a month for these materials, which is a great value because we've charged clients over $10,000 to execute the same concepts that are available in the course. But we're giving you access for free if you're one of the first 100 people to sign up at vitalstrategies.com/cornerstones. These tools will help you with the 4 cornerstones of wealth building. To be an insider, to get access to these tools to help manage your cash flow, create a tax strategy, invest wisely, and protect the wealth you're building, go to vitalstrategies.com/cornerstones. These tools are designed to help you pay less tax so you can build more wealth and live a great life. I want to remind you to rate and review the Vital Strategies podcast on your favorite platform. Your feedback helps us towards our goal of saving our clients and listeners over $1 billion in tax. Those dollars are better used in your hands versus the government bureaucracy. Thank you for listening and for being a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities for your employees and driving growth. You're vital to your family, fostering abundance not only financially, but in all aspects of life that matter. Finally, you're vital to me because you strive to build wealth and make an impact through your business and live a great life.